Solution: mitigating risks with trade finance regulations. Welcome back to our channel. In today's video, we will be discussing an important aspect of international trade finance regulations. Specifically, how these regulations help mitigate risks in international trade transactions. So, if you're involved in international trade or simply interested in learning more about it, you've come to the right place. Let's dive in. Understanding trade finance regulations. Trade finance regulations are a set of rules and policies implemented by governments and international organizations to ensure the smooth functioning of global trade. These regulations are designed to protect the interests of all parties involved in international trade, including importers, exporters, and customs authorities. The primary goal of trade finance regulations is to mitigate the various risks associated with international trade, such as non-payment, delayed shipments, and fraudulent activities. Importance of mitigating risks. International trade involves numerous risks that can adversely affect the outcome of transactions. For instance, an importer may be at risk of purchasing goods that do not meet their specified quality requirements or failing to receive the goods altogether. On the other hand, exporters face risks of non-payment or delayed payments from their overseas customers. These risks can result in significant financial losses and damage business relationships. Trade finance regulations play a crucial role in mitigating these risks by imposing certain requirements and standards that all parties must adhere to. Customs brokerage and risk mitigation. One aspect of trade finance regulations that aids in risk mitigation is customs brokerage. A customs broker acts as an intermediary between importers and customs authorities, ensuring compliance with various regulations and facilitating the smooth flow of goods across borders. By working closely with importers, customs brokers assist in proper classification and valuation of goods, completing documentation requirements, and ensuring compliance with customs laws. This helps reduce the risk of delays, penalties, or increased costs due to non-compliance with customs regulations. The role of customs bonds. Another important tool in risk mitigation is the customs bond. A customs bond is a financial guarantee obtained by importers to ensure compliance with customs regulations and financial obligations. It serves as a form of insurance for customs authorities, protecting them against financial losses if the importer fails to fulfill their obligations. Customs bonds provide assurance that the importer will pay customs duties, taxes, and any penalties if they arise. By requiring a customs bond, trade finance regulations ensure that importers have the financial capacity to meet their obligations, thereby reducing the risk of non-payment to customs authorities. Managing supply chain risks. International trade involves complex supply chains with multiple parties, making it vulnerable to various risks. Efficient supply chain management is essential to mitigate these risks effectively. Trade finance regulations contribute to risk mitigation by implementing measures such as the Importer Security Filing, ISF. ISF requires importers to submit shipment information, including cargo details and importer-buyer information, to U.S. Customs and Border Protection, CBP, before the cargo is loaded onto a vessel in a foreign port. This ensures better visibility and control over the supply chain, reducing the risk of security breaches and delays. Legal compliance and risk mitigation. Compliance with legal requirements is crucial in mitigating risks in international trade. Trade finance regulations play a vital role in ensuring legal compliance by imposing standards related to product safety, intellectual property rights, and trade sanctions. By adhering to these regulations, importers and exporters can mitigate risks associated with infringement of legal requirements, which can lead to legal disputes, financial penalties, and reputational damage. To wrap up, trade finance regulations are a fundamental component of international trade that enables risk mitigation and facilitates smooth transactions. The involvement of customs brokers, the requirement of customs bonds, careful supply chain management, and legal compliance are essential factors in ensuring the security, transparency, and efficiency of international trade. Stay tuned for more informative videos like this, and make sure to subscribe to our channel, so you don't miss out on the upcoming content. Thank you for watching, and we'll see you next time. Are you wondering if Form 50106 can be used for temporary imports or bonded warehouse entries? Well, you've come to the right place. In this video, we'll explore the specific use cases of Form 5001-6 and shed light on its applicability for temporary imports and bonded warehouse entries. So, let's dive in. First, let's understand what Form 5106 is. Form 5106, officially known as the Importer ID Input Record, is a document used by U.S. Customs and Border Protection, CBP. It is used to establish and maintain a record of importers in their Automated Commercial Environment (ACE) system. It contains essential information about importers, including their name, address, and other relevant details. The answer is yes, but with a caveat. Form 5106 is primarily used for establishing importer security filing, ISF, and is not specifically designed for temporary imports. However, if you are carrying out temporary importations, you can still utilize Form 5106 to establish your importer record, ensuring better compliance and smoother customs processes. Some text goes here. Moving on to bonded warehouse entries. Can you use Form 5106 for this purpose? The answer is no. When it comes to bonded warehouse entries, a different form called CBP Form 33461 is used. CBP Form 33461, also known as the Entry Summary, is specifically designed for submitting information related to goods stored in a bonded warehouse. So, if you have bonded warehouse entries, remember to use CBP Form 3461 instead of Form 5106. It's important to note that temporary imports and bonded warehouse entries have their unique customs requirements and paperwork. Temporary imports typically involve goods brought into a country for a specific period with the intention of re-exporting them, while bonded warehouse entries refer to goods stored in a secure facility under CBP supervision. These distinctions necessitate the use of specific forms tailored to each scenario. To summarize, Form 5106 can be used for establishing importer records, including for temporary imports. However, when it comes to bonded warehouse entries, you should use CBP Form 3461 instead. By using the appropriate forms, you can ensure compliance with customs regulations and facilitate the smooth flow of your imports and exports. We hope this video has provided you with valuable insights into the use of Form 5106 for temporary imports and bonded warehouse entries. Stay tuned for more informative videos on customs brokerage, customs bonds, importer security filing, ISF, and international trade. Thank you for watching, and remember to subscribe to our channel for upcoming videos to come.